Today is Saturday, July 30th, 2022. Let us take a look at today's crypto headlines. Cathie Wood sells Coinbase shares amid insider trading allegations. NFT potential is vast and creative possibility is endless, says Yellowheart CEO. Game yet to begin for security token offerings, Inc.'s exec says. Will the Bitcoin mining industry collapse? Analysts explain why crisis is really opportunity. Deposits at non-bank entities, including crypto firms, are not insured, FDIC. Please like, subscribe and turn on the notification button to keep supporting our channel. Cathie Wood sells Coinbase shares amid insider trading allegations. Cathie Wood's investment firm ARK Investment Management is the third largest shareholder of Coinbase, reportedly holding nearly $9 million as of late June. One of the largest stockholders of the Coinbase cryptocurrency exchange has dumped a massive amount of shares as regulators reportedly probe the firm for alleged insider trading. Cathie Wood's investment firm ARK Investment Management has sold a total of more than 1.4 million Coinbase coin shares, according to daily trade information from ARK on July 26. The sale involved 3 ARK exchange-traded funds, ETF, including ARK Innovation ETF, ARK, which all floated a total of 1,133,495 shares, or 0.6% of the ETF's total assets. ARK Next Generation Internet ETF and ARK FinTech Innovation ETF sold 174,611 and 110,218 coin shares, respectively. Based on Tuesday's closing price, the value of the sold shares amounted to slightly more than $75 million. Coinbase stock closed at $52.90 on Tuesday, losing 21% of value amid the sale. After showing some signs of revival in mid-July, Coinbase stock has been tanking as United States authorities arrested a former Coinbase global executive on July 21 for alleged insider trading. Since reaching $77.30 on Friday, the Coinbase stock lost about 32% at the time of writing, according to data from TradingView. The sale came after ARK was steadily beefing up its coin stash this year, buying 546,579 shares in Coinbase in May despite a drop in Coinbase shares. The investment firm has been actively buying Coinbase shares shortly after Coinbase debuted its stock last year, accumulating about 750,000 shares in April 2022. The stock originally opened at $350. According to a report by Bloomberg, ARK is the third biggest shareholder of Coinbase, holding nearly 9 million shares by the end of June. The liquidation reportedly became ARK's first sale of coin this year. Coinbase is reportedly facing a probe from the U.S. Securities and Exchange Commission, SEC, over the company's potential involvement in crypto insider trading. SEC Commissioner Caroline Pham expressed concerns that Coinbase might have improperly let Americans trade digital assets that should have been registered as securities. NFT potential is vast and creative possibility is endless, says Yellowheart CEO Josh Katz said that ticketing is one of the most compelling use cases for NFTs as it can prevent fraud. While some refuse to adopt non-fungible tokens, NFTs, others are finding ways to realize the potential of NFT technology to solve real-world problems. Josh Katz, CEO of NFT marketplace Yellowheart, shared his thoughts on using NFTs in ticketing. What the NFT space will look like in the future and whether NFTs can eventually surpass crypto in popularity. According to Katz, ticketing is one of the most compelling use cases for non-fungible tokens. Citing the UEFA Champions League incident in Paris where fraudulent tickets caused chaos, the CEO said that NFT tickets are the solution. By providing immutable proof of authenticity for every ticket issued, venues and artists have an effective defense against ticket counterfeiting. When asked about his thoughts on what the NFT industry will look like in the years to come, Katz said that NFTs will be involved in many day-to-day activities in various industries. He said that this will happen when people realize that NFTs can increase engagement and cut out intermediaries. The growth potential in NFT uptake and implementation is vast, and the creative possibilities tied to this are endless. Katz also shared his thoughts on whether NFTs could become bigger than crypto like Bitcoin, BTC. He explained that there is room for both as the two blockchain-based technologies have their own unique utilities and use cases. Crypto is transforming how we make payments, and NFTs are employed to grant digital ownership and authenticity in inventive new ways, Katz said. Meanwhile, a study revealed that one of the hurdles that the NFT market must surpass is consumer trust. A survey conducted by the National Research Group showed that only 15% of respondents have complete trust in NFT marketplaces. Despite this, the research showed that there's an openness among fans to learn about the technology. Game yet to begin for security token offerings, Inc.'s exec says. The current crypto bear market had no direct impact on the STO platform Inc. because STOs are very different from others in the space. Despite some of the first security token offerings, STO, having launched at least 4 years ago, the STO industry is still yet to take off. According to an executive at the Inc.'s cryptocurrency trading platform, the STO industry is still nascent compared to the overall digital asset industry as companies and individuals are just getting into the field. Inc.'s Chief Business Officer Douglas Borthwick said in an interview with Cointelegraph. According to Borthwick, there is still a huge educational gap between those who are aware of STOs and those who have never heard of the term. Also known as a tokenized initial public offering, IPO, and STO is a type of public offering involving sales of tokenized digital securities, or security tokens, on security token exchanges. Security tokens can be used to trade real financial assets such as equities, fixed income or real estate and use blockchain to store and validate token transactions. Inc. became the first company to hold a tokenized IPO approved by the United States Securities and Exchange Commission, second, raising $85 million in 2021. The platform has since listed 5 private security tokens like the Blockchain Capital Token, KA, and 1 public token, the Inc.'s token, Inc.'s. We believe the game has yet to begin, as players only now are going onto the field, Borthwick said, noting more offerings are required to increase the functionality of STOs. As more and more companies become STOs through a public offering, attracting tens of thousands of investors, then we will begin to see much more progress, he stated. In the meantime, Inc. is focused on solving up-to-date issues around the STO industry such as lack of awareness and education. The firm is specifically working with financial professionals, educating them on the STO process and the efficiencies, which, according to Inc., will lead to more issuers. It hasn't taken off yet, but it certainly feels like it is poised to, the Borthwick said, adding. Given the efficiencies of the blockchain, all assets will migrate to the blockchain, and given recent warnings from the SEC, current digital projects classified as utility tokens may be reclassified accordingly. We have built the playing field and are now teaching the rules and identifying the process. Borthwick said that Inc. is working to draw a line between the STO industry and the overall cryptocurrency market. We are distinguishing STOs from crypto, as they really should not be in the same bucket, he said. The exec also emphasized that the current crypto bear market had no direct impact on Inc. because STOs are very different from others in the space. We do not leverage client funds, We do not take proprietary risks and we do not take the other side in investments. Rather, we should be thought of as a broker/dealer that helps clients raise capital, and then provides a platform for liquidity. We are different. In March 2022, major software crypto wallet Exodus went public on the digital asset securities firm Securitize Markets following a $75 million crowdfund capital raise. Will the Bitcoin mining industry collapse? Analysts explain why crisis is really opportunity. Many BTC miners are in a tough spot and a few could collapse, but experts say the industry is here to stay. Bitcoin mining involves a delicate balance between multiple moving parts. Miners already have to face capital and operational costs, unexpected repairs, product shipping delays and unexpected regulation that can vary from country to country, and in the case of the United States, from state to state. On top of that, they also had to contend with Bitcoin's precipitous drop from $69,000 to $17,600. Despite BTC price being 65% down from its all-time high, the general consensus among miners is to keep calm and carry on by just stacking sats. But that doesn't mean the market has reached a bottom just yet. In an exclusive Bitcoin miners panel hosted by Cointelegraph, Luxor CEO Nick Hansen said, "There's going to definitely be a capital crunch in publicly listed companies, or at least not even just publicly listed companies. There's probably close to $4 billion worth of new ASICs that need to be paid for as they come out, and that capital is no longer available." Hansen elaborated with, "Hedge funds blow up very quickly. I think miners are going to take 3 to 6 months to blow up. So we'll see who's got good operations and who's able to survive this low margin environment." When asked about future challenges and expectations for the Bitcoin mining industry, Pretty Incorporated advisor Magdalena Granovska said, "One of the biggest challenges that we've had in this transition to a low-carbon economy and reducing GHG emissions has been an underinvestment in technology and infrastructure by the public and private sectors. What I think is really amazing about Bitcoin mining is that it's really presenting a completely novel way to fund or subsidize the development of energy or waste management infrastructure. And that's a way that's beyond those traditional taxpayer or electricity ratepayer pathways, because this way is based on a purely elegant system of economic incentives." Will Bitcoin destroy the environment? As the panel discussion shifted to the environmental impact of BTC mining and the widely held assumption that Bitcoin's energy consumption is a threat to the planet, Blockware Solutions analyst Joe Burnett said, "I think Bitcoin mining is just not bad for the environment, period. I think if anything, it incentivizes more energy production, it improves grid reliability and resilience, and I think it will likely lower retail electricity rates in the long term." According to Burnett, Bitcoin mining is a bounty to produce cheap energy, and this is good for all of humanity. Will industrial Bitcoin mining catalyze the long-awaited mass adoption of crypto? Regarding Bitcoin mining dominance, the future of the industry and whether or not the growth of industrial mining could eventually lead to crypto mass adoption. Hashworks CEO Todd Essie said, "I believe that most of the mining down the road will be held in the Middle East and North America, and to some extent Asia. Depending upon how much they are eventually able to cut off. And that really speaks to the availability of natural resources and the cost of power. While it is easy to assume that growing synergy between big energy companies and Bitcoin mining would add validity to BTC as an investment asset and possibly facilitate its mass adoption, Hansen disagreed. Hansen said, "No, certainly not. but it is going to be the thing that transforms everyone's life whether they know it or not. By being that buyer of last resort and buyer of first resort for energy. It's going to transform energy markets and the way it is produced and consumed here in the US. And overall, it should significantly improve the human condition over time. Don't miss the full interview on our YouTube channel and don't forget to subscribe. Disclaimer: Cointelegraph does not endorse any content of product on this page. While we aim at providing you all important information that we could obtain, readers should do their own research before taking any actions related to the company and carry full responsibility for their decisions, nor this article can be considered as an investment advice. Deposits at non-bank entities, including crypto firms, are not insured, FDIC. The government agency said that while deposits at insured banks were covered for up to $250,000, no such protections applied to those at crypto companies. The United States Federal Deposit Insurance Corporation, or FDIC, has issued an advisory informing the public it does not insure assets issued by non-bank entities, such as crypto companies. In a Friday notice, the FDIC advised banks in the U.S. that they needed to assess and manage risks in third-party relationships with crypto firms. The government agency said that while deposits at insured banks were covered for up to $250,000, no such protections applied against the default, insolvency, or bankruptcy of any non-bank entity, including crypto custodians, exchanges, brokers, wallet providers, or other entities that appear to mimic banks. Some crypto companies have misrepresented to consumers that crypto products are eligible for FDIC deposit insurance coverage or that customers are FDIC insured if the crypto company fails, said the FDIC. These sorts of statements are inaccurate and can cause consumer confusion about deposit insurance and harm consumers under certain circumstances. The advisory followed a Thursday letter from the FDIC's Enforcement Division, in which Assistant General Counsels Jason Gonzalez and Seth Rosebrook claimed crypto lender Voyager Digital had made false and misleading statements concerning insured deposits. The legal team suggested the FDIC would insure neither Voyager customers nor funds deposited to the platform against the firm's failure. Customer confusion can lead to legal risks for banks if a crypto company or other third-party partner of an insured bank with whom they are dealing makes misrepresentations about the nature and scope of deposit insurance. Moreover, misrepresentations and customer confusion could cause concerned consumers with insured bank relationships to move funds, which could result in liquidity risk to banks and in turn, could potentially result in earnings and capital risks. The FDIC began insuring deposits in 1934, first starting with up to $2,500 in coverage. Since that time, the government agency reported no depositor lost a penny in an FDIC-insured bank, despite more than 9,000 such institutions failing before 1940. The FDIC reported that 561 insured banks failed between 2001 and 2022, reaching a peak of 157 in 2010. Don't forget to like, subscribe and turn on the notification button so that you won't miss any updates.